Well, good morning, everybody. My name is Kevin Uphill. I'm the chairman of Avondale Corporate, and welcome to our webinar, Selling a Business Post-COVID-19, 9 Ways to Prepare. Now, the inspiration for this, I think some people feel that it's not necessarily a good time to be selling a business. We might challenge that, but regardless, when selling a business, there are some important things to do, important steps to take to prepare a company for sale. So we want to examine that over the next 50 minutes or so. We will be taking questions, so please fire away if you have any questions as we go. I think that's quite important. The first half, I will be running a little bit of a chat on what I see in those 9 ways to prepare. And then the second half of the webinar, I'll be joined by my colleague, Tim Hardman, co-director and managing director. And we'll be chewing the fat on some of the things. Tim will perhaps help us prioritize some of the rules, but may also just disagree and point out some other stuff. So that's good. But also, as I say, fire away your questions and we'll try and deal with those in the second half of the webinar. We will be recording, so if you enjoy it, circulate it to friends, colleagues and advisors. You know, today this is about you and your clients and how you get value. So let's crack off. Well, the first thing is that we still see the market as being quite active, and we're actually finding that there are more buyers than sellers at the moment, which may in fact mean, of course, if you've got a good company, now is a good time to sell a business. And although we're going to be talking about preparing for sale, I think there's one other motivator that we should look at when you're looking at this should I prepare or should I go equation, and that is that we do think that the capital gains tax headwind may increase. In March, it went from 10 to 20% over £1 million, and it's under the spotlight again and has been referred to the Office of Tax Simplification. So we've got a struggle coming up. You know, should we be selling businesses now with the COVID backdrop? Or do we hang on, prepare them, but then risk tax increases coming later? We can't answer that. We think it's so important that we're actually going to run a webinar purely on tax strategies. So, but the good news is buyers are out there, we've still got deals, and valuations are holding, and mainly around people also accepting COVID specific adjustments. So we might explore that a bit, but that's not the main purpose today. The main purpose is how do you prepare a company for sale? So we've done these as rules, and to get going and to crack on, rule number 1, leadership versus management. Now, valuations are based on risk. The higher risk your business, the lower the valuation. And one of the key areas and our speciality, by the way, is emerging mid-market. We're working with a lot of entrepreneurial businesses, 10 to 300 employees. They can be very shareholder owner driven. That is high risk for a buyer to take over because they've got to replace you or rely on you staying. Not such a challenge with private equity, but we should talk about that a bit later as well. But leadership versus management is kind of saying, look, guys, the more dependent the business is on you, the less value it's likely to have. The more team-driven the business is, the more value it's likely to have. And we came up with this model here. You see the triangle. So the foundations are IT, HR, premises. The profit engine is marketing and sales. And then the top part of the triangle is strategy. Now, the key is you will plateau if you spend all your time in the bottom half of that triangle. So it's actually about creating awareness for shareholders. And if you like, the top tip here in terms of preparing your company for sale is be absolutely mindful of where you spend your time. If you spend all your time in the operations, you spend all your time in management, which is typically, is Fred any good at his job, then you will probably plateau and may not drive the growth. If you spend more time in strategy, how can we be better? How can we be ahead of the competition? What new products, strategic alliances and territories do we need? How do we make sure that we're more efficient? Then you will have a stronger business model post-COVID. So I know we've all been forced to be hands-on with the COVID situation. We've all been firefighting, there's been a lot of compliance, a lot of key decisions to make around social distancing, but we mustn't forget that strategy. when we help people prepare for companies for sale, and we'll also be launching shortly some scale boards, which are sort of peer-to-peer learning around scale up, creating shareholder value. But what's interesting, when we talk to about 100 entrepreneurs a year, understanding the way they spend their time is one of the key valuation drivers, and making shifts in the way they spend their time is, of course, low cost. There's no need to get investment. It's all about getting holding the mirror up and helping them understand where to focus. And so, the classic is lots of board meetings, normally about how we make more profit tomorrow or how we deal with COVID stress, rather than how do we make the business more competitive and better than our competition and drive it ahead of the market. So leadership versus management, strategy, as well as profit and loss. Rule number one. Rule number two, stand out in the blue ocean. Now, there was a book on blue ocean strategy. I can't remember the names of the guys, but please Google it. It's quite good. Blue ocean is where you're trading in good, clear blue water, if you like, in the Bahamas, with very limited competition and lots of fish. Red ocean is there's lots of sharks, too much competition, margins are deteriorating. Now, to a certain extent, with COVID, we've all got a red ocean, because ultimately the economy has so far, well, forecasts are it's going to contract by 10% in the UK this year. Good news, by the way, that's not as bad as the 14% they were originally forecasting, but a 10% contraction means too many companies scrabbling for the same business. So this blue ocean is, how do you find a niche where you can stand out ahead of your competition and create pull in your business? By pull, I mean where your customers seek you out rather than you having to push and seek them out. We've been working on our own version. Originally, Avondale was very marketing led. We were having to, keep knocking on the doors of people to say, hey guys, we do deals, we help people buy and sell companies. But actually, more and more of our business is through referral and networking. So that's pull as we get recommended and people see what we're doing. So it's, what niche can you own? How can you stand out? Why are you better than your competitors? How can you choose a niche where margins are higher and also where you've got significant growth prospects? So this is actually about taking a strong, hard look at the whole organization and considering whether your products, services, and business models are correct, and then looking for that area where you can break through, where there's less barriers to growth. Of course, with COVID, we've got to mention this, be resilient. And by that, I mean, listen, I don't know about you guys, but it's been quite an emotional time from time to time, quite stressful from time to time. And I'm robust, and I like to think I'm focused and keep going. But it's not easy. We are running into headwind daily. I was out actually literally running with a mate the other day. I said, I'm bloke like as I am. I said, look, how are you doing? And he said, yeah, I'm all right. But he said, you know what? I came off a call the other day. We've made a couple of people redundant, really difficult boss. And then the kids were all screaming at me. And I just put my hand in my head and started crying. And I thought, you know what? I kind of know that feeling. But look, we've all had a little bit of those moments. But actually, the key is look after yourselves. Take an hour a day to think about how you are taking care of yourself. If you know how to manage yourself, then you can manage others. And from there, in my opinion, resilience comes. And if we're looking at either selling or preparing a company for sale, we've got to have fresh minds. That blue ocean strategy is actually all about blue sky thinking, and that is not obvious, and it takes fresh minds and fresh perspectives. So we've got to be very careful not to be focused all the time on firefighting and COVID management. And we've got to be spending time looking at those business models. And within that, of course, so rule number 3, be resilient, and recurring revenue is, of course, a key point to resilience. The more recurring your revenue, the more sustainable the business model. So we need to also, when we're looking at the strategy, where can we find recurring revenue streams and how can we build those into the business model, because they are more valuable. Be productive, rule number 4. Well, I think this is an obvious one, but not everyone's been working on it. I think historically, we as businesses have often said, look, actually, we're growing. Let's employ. Oh, sorry, I've changed slide. Let's employ somebody else. Whereas actually, what would be better is if we look at the systems and processes that people are working on, and we'll figure out how we can get more out of the existing resource. So that's things like looking at IT. But the other one, when we're doing strategy work, it's quite interesting how many companies we meet where, particularly with the senior team, the roles and responsibilities aren't clear, they're double touching, and certainly accountability is not clear. We do run a model, we call it cultural to commercial. So cultural is kind of like the village where everybody's helping each other, and that's great. Commercial is like the city, roles and responsibilities clear, you're held accountable, bottom 10% out every year, 360-degree appraisal, do your job or you're off. Now, I'm not saying one or other is right. What I am saying is, where are you? And examine that within the context of your management and understand where you are deficient in terms of either accountability or double touching, and then you free time up. Basically, productivity is if you're turning over 100k per head, can you turn over 150k per head? It's that simple. But the other thing is looking at yourself versus your competitors. So pull those company searches. Where do you sit per head against your competition? If you don't do it, trust me, your buyers will be looking at that, because it's a key point for them when they're looking at buying a company. It's a key KPI. So this is all about processes, systems, and efficiency. And what can you do to build that into the business model? Rule number 5, I think this is a real, I mean, the trend was there anyway, but this is a real COVID point, and probably for me, the top point that I'd like to bring out, which is the last 3 years' accounts are irrelevant. It's what's happening now, what's the forecast, and what's the work in progress. And increasingly within that, what's the demographic of growth that we've got, and how do the forecasts fit that growth? So, there's some real financial work, there's some real data work, there's some real KPIs and systems that need to be put in place to sell a business, because people are real-time tracking that information. So, almost like vendor due diligence, the top tip on this is the financial position has to be clear, it has to be demonstrated as sustainable. And what we're looking for now, of course, post-COVID, is what is the run rate, what is the growth rate from lockdown, what is the work in progress from lockdown, and how is that going to affect deal and deal structures. Buyers are taking a view, but they have increased deal structures related to that rate of growth and that lockdown easing. So, of course, the other thing that we think is important, and we allude to this, a virtual data room. Every project we run a virtual data room, and it is really designed to show that real-time performance in a business, so buyers can see what it is they're acquiring. And of course, the benefit of the data room, of course, it's global and it's virtual, so that deals with the COVID era. So for us, short form marketing IMs, more work in the data room, particularly around dashboards and data tracking. Rule number 5, look at the systems. How can you create that data? Rule number 6, put technology at the center. Do you know what? This is kind of similar to the productivity point, but a little bit different. Again, we were seeing this trend a bit more before COVID, but I think COVID has accelerated it. We've all become very aware that every organisation needs to survive on a virtual basis, and indeed every organisation to do that needs highly robust virtual systems. And actually, this is about businesses that put IT at the centre. We wrote an article the other day, IT is the hub, not the spoke. I think increasingly IT is the centre of a business model rather than at the peripherals and an added on value. And indeed, this is where you get productivity. So, I mean, again, just a bit of a share, but one of the things we've done post-COVID is we've put more training sessions in for our people, because we've got a really good platform. It's a little overcomplicated. Yes, guys, it's Salesforce, sorry about that. But actually, it's really good. and we just don't use it to full capacity because we haven't spent enough time training people on it. So maybe you've got a system, but it's about little tweaks you can do to improve it, and then backing that with training to increase the productivity per head. But digital technology will be a due diligence point for buyers, and they will be looking at how good it is, how sustainable it is, and actually how it's driving your business model, not just supporting it. Rule number 7, break through the glass ceiling. Well, I mean, this is a fancy way of saying, look, businesses with growth prospects are more valuable than those without. Well, of course, that makes sense. You know, imagine walking into the room, I want to sell my business, we're a bit tired, we're starting to plateau. It's not a great sales message. The great sales message is, guys, we've got a really great product, we're in a really great niche, people are starting to seek us out. We are growing. Okay, COVID's creating drag on that growth, but the fundamentals are good. And look at this demographic. There is significant growth prospects against this demographic. So if you don't buy us, we're only going to get more valuable because we're going to grow within that space. And so this is, again, it's a little bit about positioning your business, but it's also about knowing your market. Again, when we're working with sellers to prepare for sale or launching a project, you know, we will do a competitive analysis, and we will understand how big the market is and what percentage our client has got, so that people can see the opportunity for growth. And that's particularly important for investors. Now, I said earlier, people are acquiring businesses. You know, trade are a little distracted still, but in particular, private equity are very, very focused on doing transactions. And for them, that's all about how can we create triple or quadruple growth over the next 4 or 5 years. So you've got to have that market research, and you've got to demonstrate that you are well placed to take that growth. And within that context, we're also well placed beyond the owner. It has to be team driven, and also a growth mindset. It's quite interesting how often we meet, you know, entrepreneurs that are, you know, very flexible, very focused on growth. But when you talk to the management, they are more focused on managing the status quo. By the way, you know, we create those systems. We want reliability in our business, and we need those steady Eddie type approaches to build a business. But we also need flexibility for change. And I think it's quite interesting how not much time or energy is invested in that second tier management around the agility and growth mindset and the flexibility. You know, they aren't given permission to pick up and run with stuff. It's very much about just implementing stuff. And I think that's a shame. I think there's some real energy that can be created by training the second tier management to also evolve the business on the small initiatives, whilst the leadership team get on with those bigger initiatives. If you remember my leadership versus management model, that's new products, strategic alliances, acquisitions, and possibly new territories. So how do you create a team-driven business that can break through the glass ceiling, and within the context of where the market's going and growth ahead in that market? Rule number 8, plan around your multiple influencers. This is a simple one. When we go in, we meet companies, well, we virtually meet them these days, but it's how much time do you spend on board meetings? Oh yeah, we meet once a month. How much time do you spend on management and operation? Well, all of it. How much time do you spend on strategy, new products, strategic alliances, acquisitions, and shareholder value? Well, you know, half a day a year. How are you going to break through on that basis, guys? This is about creating the space and time to design your business model and understanding, and it's different for every sector, what the key valuation drivers are in that sector. You know, you might have 2 businesses, one with $500,000 profit, the other with $500,000 profit. Business A is growing, it's got a better brand, it's got a better system, and it's got more recurring revenue. That is going to be more valuable than business B, even though they're the same sector and they've got the same adjusted profits. So there are real key things that we or our clients can do to influence the value of the business through taking time to look at the design of the business, the profile of customers, systems, and in particular, again, recurring revenue. It's probably the #1 value driver. Rule number 9, look, guys, we've got to put a plug in. You can't help it. Get the right advisors. Running a process and also preparing a company for sale is expert. It requires expert guidance. It's also much easier for somebody external to see what the key drivers are than when you're up against the cold face running the business day to day. You're being bashed about, you've got operational issues, you've got to make really key decisions. It's hard, it's tiring. Somebody standing objectively can go, well, hang on a minute, guys, what about this? And create challenge that can really bring value to the equation. Some of our value builder products and programs we've worked with, I mean, literally, we're talking doubling businesses over a year and a half pre-sale by spending time looking at how to design the business around shareholder value. So get the right advisors early on. And that's, of course, not just in the sale preparation stage. The process is also critical. And that's also come back to positioning the business when you craft the IM, the right data room environment, global research, making sure you're talking to the right buyers and investors, and ultimately within that, under this offers basis, on a no limits mindset, creating an auction process to get top dollar, top value. We've seen situations where we've been dealing with initial bids of 10 million and we finished up with 18. Now again, post COVID, slightly less buyers, so those auctions are going to be a little bit more fragile. But if you're only talking to one buyer, you are not going to drive the best value. So be cautious also about sweetheart buyer that's approached you direct, because it may not be the best value. If you've got one of those, come to us. We'll tell you whether we think it is or not. We're busy. We won't tell you what we want to hear. We'll give you a measure. And I think again that's important. Guys, we've got some accountants on here. Accountants can value businesses, they can do the maths, but a market maker can tell you what's happening with current deals and give you more on the comparative analysis of other deals being done in the space. So get quality advisors early on. Hopefully that's us. And I always like to think, listen, guys, if you're going on a journey to sell your business, it's important to also pick advisors that have got a track record in your sector and really understand your ambitions well, and take the time to understand the fundamentals of the business. And that does mean managing your expectations. It's important to look at a business strengths and weaknesses, as well as that optimism around the auction. So that's a whirlwind. We've had a question in, but it'd be good if you could fire more questions. I'm now going to bring Tim, my co-director, in, and we just sort of want to chew the fat on some of the stuff we've talked about there. But Tim, we've had a couple of questions. Welcome, Tim. I hope you're well, by the way.
Morning, everybody. Morning, Kevin.
Good. Okay. Are you well?
All good, thank you.
First question. Okay. I like this one. It came. I'm in due diligence at the moment. The buyer is interrogating us at every step. Is this normal?
The short answer, yes. The buyer will interrogate at every step, and I can come back to numerous of Kevin's 9 points there. But I think the key one is, and I actually just wrote this down when Kevin was talking, is you need to prove things to a buyer rather than just tell them. And telling them is great at the early stages when they're deciding whether you're the right opportunity for them, the fit is right, and all the rest of it. But nobody will proceed and actually write that check without the concrete evidence to back it up, which then brings back and reinforces Kevin's point about IT being the hub, not the spoke, because most of this real-time data, or a lot of the real-time data, will be created by your IT systems. You need to be able to push the button, the machine go ka-chunk, 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 and throw out the report the buyer is looking for.
And that's about joining the accounting system to the CRM or the ERP, and it's quite interesting how many people haven't achieved that, Tim. Do you think that's because people don't invest in financial and IT? They see it as a cost, not an investment?
I think there is that, but I think the key point is what drives that. And in a bizarre sort of way, people know their own businesses too well, or believe they know their own businesses too well, and therefore they don't feel a need to generate the evidence for their own purposes. And that's when they fall foul when you're talking to a third party, because that third party does not know your business that well. And that seat of your pants, 10 vans went on the road this morning, or we had lots of inquiries today, or the phone seemed busy today, or whatever else it might be, that's not good enough for a buyer. They need evidence.
Well, we'll come back to that because I want to talk about vendor due diligence in a minute. But before I do that, Tim, we've had a good question. I mentioned recurring revenue 3 or 4 times, and there's a guy, Simon here, with a specific question, a recruitment company. Can you give examples of recurring revenue? We are a recruitment company and clients tend to pay on deal done. What's our advice there?
Well, without knowing a little more about your recruitment company, I mean, typically recruitment is broken down into permanent recruitment and temporary or contract. Now, temporary or contract tends to have that recurring revenue stream, i.e. you place somebody at a client, they are there for a period of time and money keeps rolling in for the duration. If your speciality is permanent recruitment, it may be possible to come into the contract or the temporary space, which will create that recurring revenue stream. Alternatively, if permanent is where you are and that's very profitable for you, you're closer to our business model. If we sell somebody's business, it's going to be donkey's years before we get to do business with them again, in all probability. So for us, recurring revenue is the source of the projects, the source of the deals, rather than the actual client necessarily. Now, actually, in permanent recruitment, you may be in a better position in that you may supply X number of permanent member of staff to a client over any given period. And I would deem that as recurring revenue. It may not be contracted revenue, but if you've got a good history of that, I think that could stand you in good stead.
I ran a model, and I've run a model, we call it the heart of the goodwill, but basically showing the top 50 customers for the last 5 years, and then showing the repeat cycle, because most people see it flat and they look at it as 1 year and they go, well, look, here's our debtor creditors, you can see our client portfolio. No. If we do it over 5 years, then you can show that 18-month cycle or 9-month cycle, whatever you've got, so you can demonstrate the recurring nature of it through that. So there is a model there that can be built that demonstrates the recurring. But the other thing is, I remember when we did January's, which was a big commercial property company in Cambridge. They had a lot of agency staff. They were doing a lot of commercial property lettings and stuff like that. And actually they had a lettings agency and a commercial agency. Well, pre-sale, we concentrated on the lettings agency because that's lots of recurring revenue, sticky long-term contracts, whereas the big agency stuff is lumpy. And that actually, we think we probably got another £1 million off that transaction through some of that strategy. We did buy a small lettings agency pre-deal as well, so it made a big difference to do it. Okay, another question. We have a group structure and 3 trading companies. Would one trading entity generate a better multiplier? Tim, don't answer that yet. Don't answer that. I want to come up with a bigger question. Sale preparation is normally about vendor due diligence. It's about compliance. It's about getting your records in order. It's about getting your company structure in order. It's about making sure your terms and conditions are right. I didn't put that as one of my rules because I think doing your own vendor due diligence is obvious, as I think looking at things like structure. Yes, it's important, we should do it, but I think an audit should be done at least a year beforehand. But should I have put it in as a rule, that corporate governance point? And this is a corporate governance question, really, isn't it?
It is. I mean, if I'm honest, I see that's a housekeeping point.
Yeah.
So, I mean, if I can answer the individual question directly and then come on to the bigger picture, because I think that tells a story. To give the slightly flippant answer, I mean, I couldn't give a monkey's whether your group structure is Topco with 3 subsidiaries, 3 individual trading companies, all lumped together as one. It's not rocket science to go and consolidate figures and so on and so forth. For me, the bigger picture is what is the commercial logic behind your structure. There may be some minor tax implications, but I shouldn't think they are going to be enormous. So are you protecting something within one of your organizations to keep it away from the others, for example? You know, is there a very, very valuable contract you're protecting in one, or any other reason? But I think for me, it's about what are the commercial drivers behind that structure. So I see it as a bit of a housekeeping point.
Yeah, but again, it comes back to actually, guys, getting advice early on and getting people in that will support you. And again, these scale-up boards that we're going to be launching would be a method of support. Isn't necessarily expensive. So if you have got things that aren't quite right and will get in your way, and say without knowing specifics, it's always impossible to answer. But they're not difficult to sort out in advance. Where the challenge comes is if you're doing it at the point when you're trying to do a deal, and then you're all scrabbling around, aren't you?
Yeah. Can I slightly contradict my own point? We had a client many years ago who was a sole trader, unusually so for the size of the business. And I'm going way back into, so, you know, capital gains tax, entrepreneurs relief is a hot topic at the moment. So I'm going back as far as taper relief, where there was a 4-year qualifying period.
You're getting old, Tim.
Yeah, I am, unfortunately.
Yeah.
And the client turned around to me and went, "Oh, Tim, I've just incorporated." And I went, "Oh my God, why have you done that? You've just cost yourself 30% in tax, or you have to wait another 4 years to requalify for full taper relief against capital gains tax." So whilst I've said, yes, housekeeping points, what I would also say is, and I'd echo Kevin's point on get your advisors in early, but when you get your advisors in, things that seem minor to you, you know, anything that is not normal day-to-day trading, talk to them, find out whether they have an implication on what you're trying to do. And the issue here is the client hadn't told his accountant the full picture.
Yeah, and that's again communication
and had not told us what he intended to do.
I think that's a really good point, and you see that, and you see trip ups. I remember we were dealing with a really, you know, quite successful security company, but his contract had uncapped liabilities in them. So we had a massive corporate looking at it and went, well, you know, we can't do anything with that. And it's just one line in the contract, and it made all the difference to a deal. So corporate governance and structure can be important, but yeah, actually, ultimately, it's not difficult to get that advice early on and be tidy in that area. So Tim, I'm going to try this one. We've had a question: what are our views on potential gains and tax hikes? And sitting in my lovely garden the other day, we chewed the fat on this, guys. So we're developing a view. We think it probably, it's under the radar. You know, the scope they're looking at it. Obviously, going from 10 to 20% was unhelpful, but I think most entrepreneurs didn't blink. I think we all recognise that the wealthy are going to have to be taxed more, and possibly the 10% rate was unfair. If it goes to 40%, well, interesting. We were talking to some people yesterday. We're setting it up where I think the Channel Islands is very nice. You know, Jersey, Guernsey, also Portugal. So there are always planning opportunities if that comes. But actually, you know, we also take a view that tax is tax. You can't control it. So you know, you can try and time. And that means that we may have a window, and we should be looking at that in terms of a sale right now for certain businesses. It's a challenging one, but we will be giving some more views on that. I say, please watch out for our seminar. It's going to be called The Tax Headwinds on Business Sale, and that's going to be in September, and we'll be putting some planning points forward. Tim, you want to add to that?
Well, I mean, you know, we don't know for sure where it's going. My personal view, and I'm not a tax advisor, but at best neutral, but I really do think that's a slightly optimistic at best. I do think HMRC is going to see, you know, the privately owned businesses as a source of restocking the revenue coffers, or restocking or perhaps slowing the slide rather than restocking. But So I'd be very, very surprised, very pleasantly surprised if it was neutral. I would, however, bring a point in that in conversations we have been having with clients and potential clients forever, people tend to compare gross figures anyway. And you'd be amazed how often I've had the conversation with somebody who says, ooh, I wouldn't sell for that. If I kept my company, I'd earn that in 5 years or whatever the number is. With the current tax regime, or certainly up till March, and it changed from 10 to 20 above $1 million, you'd actually find that the maths against 5 typically worked out closer to 8 or 9 years. And entrepreneurs just don't seem to start thinking about that. And my contention there is, for many, it's not about the number, it's not about the pounds, it's about the score chart. And if you're comparing gross with gross to calculate your score chart and see how well you've done in life, the old adage, he who dies with the most toys wins, then perhaps it is a secondary thing. That's me taking a slightly optimistic view.
I've got to take you on there, Tim, because I remember articulating something about that with you, about what drives me. And you said, because I said it's the idea and the creativity, not the money. And you said, fine, give me the money.
Yeah, it hasn't happened, does it?
Okay. But the other one, actually, we think, just come back post-COVID trend. I think this whole virtualization is really interesting. I might make a joke about the Channel Islands, but we had a business. We did a deal once, which was on the front page of the Sun. Nurse does well. It was a $5 million odd deal in the care sector, and they lived in Chelsea. And they said we haven't done well because we live in Chelsea. Everyone else is richer than us. But they moved to Warwick, and £5 million was a lot of money. Now I wonder whether we're going to see a trend there of because we've all suddenly realised we can work from anywhere, that actually, life is expensive if you need to live in London, but is that going to come up for grabs? People are going to examine their lifestyles more as well. So look, all bets are around on that one, and hopefully we'll chew the fat a bit more on that in September in the webinar then. We've had another question about supply chain resilience, because obviously with lockdown, people have been, importing it was more difficult. Is that relevant to sale valuation and sale preparation?
I think that's so case specific. It's a really, really tough one to call without knowing specifics about it. Yes, I mean, if you have a reliance on a particular supplier or a particular supply chain, and that supply chain drying up is going to create issues for you, yes, it is a problem. However, I do remember a deal 3-4 years ago, and we were going through due diligence, and it was a private equity buyer who was going, ooh, you haven't got contracts with any of your suppliers. And we were getting very frustrated with it, sort of continuous, the same question. And finally got to, we don't want contracts with our suppliers because our suppliers are also ran. We can get the product absolutely anywhere. Why would we tie ourselves to a contract? So I think it depends entirely on circumstances. And like everything else, it's what are your risks? Kevin, do you remember many, many years ago, we used to sort of say to people, what's the worst envelope that could land on?
Yeah.
All right, today it's probably what's the worst email that could come into your inbox.
Yeah.
And trying to think about that and what are your contingencies around that.
Yeah, I think that's still a valid vendor due diligence point, isn't it? Yeah. What's the absolute worst one, and what can you do to offset that?
But it's the classic old SWOT analysis, isn't it? Strengths, weaknesses, opportunities, threats. Let's not get carried away and buy into our own PR too much about how wonderful we are, how our business is different, how our business is unique. You need to look at the other side of the equation as well. That's fundamentally important.
Yeah. And actually, for me, again, that reminds me of a leadership versus management model. And I will confess to not being the best at this, but I'm always minded again. And, we're very lucky we get to deal with some really first-class entrepreneurs. But it's really interesting how time and time again, it's the listeners that crack it, because they watch and they listen more than they talk. And that is around just again, that time to spend on analysis and looking for those threats and on opportunities. And if you're sort of too busy telling people your own preconceptions, you'll never get there. There's a really interesting point around leadership really there. Okay, and I think come back to the supply chain question. I had one other point actually. We were doing some work last year with the childcare products. We're just going to be looking again, I think, for some private equity for this business. But they've gone from 400k to 850k profit run rate this year, or EBITDA. And the biggest issue they had was stocking supply. So one of the things we suggested was that they change credit terms with their one main supplier, which has actually enabled them to get more in the containers. They're bringing stuff in from the Far East for this childcare product, have more stock, go sell more. Pretty simple, but you know, it's nice to see the result, 450 to 850k EBITDA. And by the way, if anyone knows, we will be looking for investors or buyers for that project. So just bear in mind that childcare product or project. Tim, if you were to pick, I'm just sort of mindful of time going. If you were to pick one of my 9 points, which is the one that you would go, that's my top of the list. That's the one that I really think is number one.
I think it's a really, really tough question, because I do think it is case specific and it depends on the individual businesses. So I'm going to not answer your question. I'm going to give you two answers, or a combination of two answers. One of the key things buyers are looking for, and let's ignore COVID for the moment, because I think buyers will take a bit of a view on that. Well, and we've already seen it. Most buyers seem to be prepared to ring fence the COVID period, so long as they are seeing a return to some semblance of normality post COVID. Equally, we don't know to what extent we're going to have spikes or further issues with it. But the key thing a buyer wants to see is a growth story and a future growth story. Now, the history supports that point, but they need to buy into where that growth story is going. And I still believe the only way you realistically demonstrate that is absolute quality data. And now I'm going to bring COVID back into it and say that, historically, people might look on, 1 year versus the next. And when you're in the guts of due diligence, drill down a bit further and have a little bit of a look at seasonality and things like that. Today, we're seeing businesses changing on a weekly basis. And being all over your data is absolutely fundamental, utterly critical. I think if I could then throw in one thing into the mix that you alluded to in answering the last question, but wasn't part of the 9 points, is really look at your debtors and your creditors. We see, because buyers will look at cash flow, and this is a really, really simple thing, is the working capital requirements of a business going forward. If you can demonstrate your business requires £1 million cash to trade rather than £1.5 million cash to trade, assuming you have 1.5 million in the balance sheet, you've just added £500,000 to your purchase price. And it's as simple as that. And it's one of the biggest bun fights that will go on through due diligence is, what are the working capital requirements of a business? So a couple of tips around that. One is, maximize within contractual terms, the terms with your suppliers. And too many businesses are sitting on cash mountains, or well, not even cash mountains, but are comfortable from a cash flow position. I was talking to a guy in the wine industry 2-3 weeks on this point. He had 60-day terms with all his suppliers, and he was paying them all on receipt of goods. And he said, because it's easier. I said, well, it is, but how are you going to now prove what your cash flow requirements actually are? So use that. And then depending on your business model, if you're B2B and giving customers or clients credit terms, make sure you're all over that. Because it's all very well and good turning around to a buyer and saying, oh yes, but I don't use my contractual terms. Yeah. The buyer will then turn around to you and go, is that why you're getting such a good rate? Because you don't use your contractual terms. So you need to prove it.
And that's interesting, Tim, because obviously within our strategy team, these are guys that sort of go out and help the growth and shareholder value. But they've developed some specific projects, which is sort of the business review, the marketing review, and of course the financial review, because a lot of people, they've got finance controllers that are called finance directors, but they're not finance directors. So, a finance director will be looking at, gearings and ratios, not just counting the money. So, there is real opportunity there to tidy up or financially engineer post-sale to create the best preparation. So I think that's also.
But I think it's a very, very good business discipline anyway. And I think that's one point I would like to make to everybody is all of Kevin's points are good business disciplines, even if you are not improving or learning or analysing for the purposes of having conversations with buyers. It's good for yourself. And one of the points we get continuously is where we are going through a sale process. The seller will, during due diligence, and I think without exception, number one, go, my God, this is an absolute ball ache. Why are they asking me such stupid questions? And more to the point, why are they asking me the same question over and over again?
Everyone gets rid of that. Anyway, yeah.
But number two, almost without exception, they go, my God, I've learnt about my business going through this process.
Yeah.
So regardless of whether you are thinking of an exit, planning an exit and all the rest of it, there's just some really, really good business improvements you could make by thinking about this sort of stuff.
Yeah, and there's sort of, again, it's not vendor due diligence, but if you set yourself up, you don't forget, you've got to persuade people to invest in your business on a risk basis, and that's not just the managing director. It's great being a good salesman and going, look, guys, we can do all of this. You've got to persuade the finance director, and he's utterly measured and all about dealing with risk. So unless you've done that work, you're going to struggle, aren't you? So you got to get the vision across to both. And of course, if there are investors involved, they're even drier than finance directors. They will ask every single question, and they will ask it in 5 different ways in due diligence. So it can be quite intense, but I suppose a good advisor will create a big buffer for that, and that's something we certainly pride ourselves on. So you can concentrate on growing your business whilst a process is being run. Now, I'm mindful we're running out of time, so I think that was a useful session. Tim, you got anything you really want to say at the end here, or done?
I think just to reiterate the previous point, I mean, we genuinely believe this is good stuff for business as well as just looking at exit strategies. So, to all of you, I'd say, whether you're here on behalf of clients and wish to share this with clients, please do. Great stuff. Or whether you're using this for your own purposes, and we're delighted to talk to any of you, answer any questions you may have offline.
Yeah, and I'd mirror that in terms of resources and studying. Do you remember I said that, leadership versus management, spending your time on strategy and shareholder value? We've got the resources to back that up for clients. We're going to be launching a new front page of the website, so you can get access to the technical guides and the webinars. They're all up there at the moment, but it's a bit higgledy-piggledy. But it's there, so please use it. We've taken the time to write it down, whether it's valuations or exit strategy options. It is there. Very technical guides, so that it's not just the optimism. It's let's get all the steps in place to make sure this is not left to chance. And the strategy is realised. So if you've enjoyed today, we've got more webinars coming up. We've got Scale Up on the 17th of September, and really that's a mindset webinar where we'll be looking at why is it that people do plateau and how you break through the plateaus in businesses. So it's more of a strategy webinar than it is an M&A, but please join us 17th of September. Hope you've enjoyed today. And stay well. Cheers.
Thank you.